You know, please record so that we can. I hope you recorded all the ones you did when I was not here.
We recorded most of them, so we'll share with you.
Okay. Now I'm going to be reminding us to record all of them, not most.
Okay. So, Mr. Oluwatosin, you want to read this one?
Yes, sir. Which of the following is not true regarding the life with guaranteed minimal annuity settlement option? A. Payment can be made in installments and a single cash refund. The beneficiary, oh, sorry. I'm sorry.
Okay, that's okay. We're not supposed to read the options. We read the options silently and locate what the answer is. I like this question.
Make me think. Trying to eliminate those ones that are true. Is this C?
I'm thinking C too.
C. It does not guarantee that the entire principal amount will be paid out. Because every other one seems to be true. It's a life contingency option.
So let's see. So you say it does not guarantee that the entire principal will be paid. Let's go back to the question. Life with guaranteed minimum annuity settlement. How about if that annuity is worth $500,000 and the guaranteed minimum is $300,000?
The question is it's not true.
Correct. That's what I'm asking. You say C.
Okay.
C says it does not guarantee that the entire principal will be paid out. That is true. Because if the guaranteed minimum is $300,000 and that annuity has grown to $500,000, then what is guaranteed? What is guaranteed is the $300,000. So it's true. It does not guarantee that the entire principal will be paid out.
Okay.
So I send you back to the drawing board.
Is it the life contingency option? I thought annuity was life contingency.
Yes. And it is.
Okay, let's go back to the question. Ms. Oluwatosin, read that question.
Which of the following is not true regarding the life with guaranteed minimum annuity? Oh, settlement. Okay. Settlement option. Yeah. Settlement. Okay.
Yeah. D says it is a life contingency option, which is true.
Yeah.
It says life with guaranteed minimum annuity settlement. So they pay you for as long as you live, but there's a minimum that they must pay.
Yes,
so D says it is a life contingency option, which is true. The first thing says life.
Payment can be made installments, yes, and
we're left to B then.
Cash. Yeah, I think so.
All right, between B and A, A says payments can be made in installments as
a single
cash refund. B says the beneficiary receives the remainder of the principal amount upon the annuitant's death. B is certainly false. A, I'm not sure.
It should not be because of the refund, cash refund or something.
Yeah, I mean, if something is left for the beneficiary, it can be made in installments or as a single cash a refund, which is true. Again, let's say the annuity is worth $500,000. The guaranteed minimum is $300,000. if before the annuitant dies, and the annuitant is the person who benefits from the annuity, is the person who is collecting money from the annuity. If by the time the annuitant dies, he has collected 200,000, it means there's still 100,000 to go to achieve that guaranteed minimum. That 100,000 can be paid in installments or as a single lump sum, which is true if we look at it from that perspective. It just depends on what perspective they're asking. But B says the beneficiary receives the remainder of the principal upon the annuitant's death. That is false. Why? Because it says which of the following is not true regarding life with guaranteed minimum annuity settlement. Let's say the principal is $1 million. The guaranteed minimum is 500,000. If the annuitant has collected, say, 400,000 and then dies, remember the principal again is $1 million, and this says the beneficiary receives the remainder of the principal amount upon the annuitant's death. No, he or she will receive the remainder of the guaranteed minimum, not the principal. Let's see if that's correct. Ooh.
He received the principal amount.
It says C. Let's see. It says which of the following is not true? The beneficiary receives the remainder of the principal amount upon the annuitant's death. Which of the following is not true? C says it does not guarantee that the entire principal will be paid out. Let me go back to that question. It says which of the following is not true?
You know why I was leaning with that question?
Guarantee, sir, it's guaranteed that the entire principal amount will be paid out.
You know why I went with
That's
that
why the
answer?
beneficiary receives the remaining principal amount that is left. But this one says it does not. So I think that is why.
You know why I went with that question. Now,
yes,
the entire amount left over, okay? We are not really sure that the question that say it does not guarantee. Yes, it doesn't guarantee because we don't know the entire amount that is left over. That is my logic in going with the C.
I would disagree with them.
Okay.
So let me read from the manual. That's where I'm reading presently. Under the life with guaranteed minimum settlement option, if the annuitant dies before the principal amount has been paid out, the remainder of the principal amount will be refunded to the beneficiary. This option is also called refund life. It guarantees that the entire principal amount will be paid out.
It says it does not, which rules out.
Yes, that's why we picked C. But from the manual, it says it guarantees that the entire minimum amount will be, principal amount will be paid out. So that's where I am currently in my study. So, and that's chapter 5. I'm wondering why it's in chapter 2 here.
Can we read the rationale, please?
Okay. Yes.
Mr. Ebuko Nolowa, can you read the rationale?
Okay. I missed this. Okay. With the life with guaranteed minimum annuity settlement option, if the annuitant dies before the principal amount, the amount paid for the annuity has been paid out. The remainder of the principal amount will be refunded to the beneficiary. Pure life provides the highest monthly benefit for an individual annuitant.
Okay. I still have not reconciled it, but I'm going to let you guys keep C as the answer.
Okay.
Yes.
Let's move forward.
Correct. Yeah. All right. So, Miss Ebuko Nolowa, can you read this one?
Yes. An individual has been making periodic premium payments on an annuity. The annuity income payments are scheduled to begin after 1 year since the annuity was purchased. What type of annuity is this?
Deferred.
I think it's deferred.
Yeah.
Very true.
Mhm.
Correct.
Correct.
Let's go with 5. Miss Karen, can you read this one? Miss Lola, can you read it?
Okay. The main difference between immediate and deferred annuities is when the income payments begin.
Yes. Yes.
She shot straight to the answer. I like that one. Shows she's been studying. Correct. Next question. Miss Florence, can you read this one? Miss Vera, if you're there, can you read this one? If Vera is not able, Des, can you read this one?
Why is everybody running from the question and referring to me?
They are not paying attention.
Okay. What form of the annuity settlement option provides payment to the annuitant for the rest of the annuitant's life and ceases at the annuitant's death?
Okay.
Hmm?
Is it pure?
It's
Pure life.
life.
Yeah.
If it's life, it shouldn't be pure life.
Correct.
Pure life.
Mm-hmm.
It's straight life. It's the same thing as like pure life,
It's the
straight
same as
life.
pure life.
Yeah.
Okay. Mr. Oluwatosin, you want to read this one?
Okay, sir. If an annuitant dies before annuitization occurs, what will the beneficiary receive?
Is C.
C. Either the amount paid into the plan or the cash value, whichever is greater. Yeah.
Correct.
Yeah.
All right.
Yes.
Miss Lola, can you read this one?
A straight life policy has what type of premium?
Level annual premium for the life of the insured. B.
The
Correct.
level premium.
All right.
You guys have become so good, huh?
Practice makes perfect.
Oh my goodness.
Miss Ebuku Noloa, can you read this one?
Yes. A married couple's retirement annuity pays them $250 per month. The husband dies and his wife continues to receive $125.50 per month for as long as she lives. When the wife dies, payments stop. What settlement option did they select?
D.
Joint and survivor.
Joint and survivor.
Yeah.
Mhm.
Correct.
That's a tough.
Excellent. Miss Geraldine, can you read this one? Miss Geraldine, can you read this one?
Under a pure life annuity, an income is payable by the company
For the life of the annuitant. B.
would be
Correct. Okay. Number 11, Miss Ebuko Noloa, can you read this one?
What type of premium do Universal Life variable universal life policies have? Universal life and variable
Flexible.
policy. Isn't it increasing?
I'm not sure.
Flexible?
I'm thinking flexible. Indeed.
Flexible.
Flexible.
Yeah.
Whenever you see universal life,
Mhm.
they're talking about flexible premium
Flexibility.
policies.
Yes.
Yeah. That's right. That's
Yes, and
Yes.
even variable too.
Correct.
Mhm.
Miss Lola, you want to read this one?
right. Which of the following terms best describe the coverage provided by term policies as compared to any form of protection? Best describe. It's not longest, it's least.
Coverage.
Compa
I think it's
Compre-
greatest.
term life.
Is
Term life
Term
and
life is cheapest, right? Is does the cheap and the
the
least and long greatest mean the same thing?
greatest. So something, yeah, something like greatest.
in what
The
term?
highest form of protection.
As compared to any form of protection.
Yeah, it provides the greatest because it provides the greatest amount. As Desmond says, it's cheap.
My goodness, I didn't think cheap and greatest are the same.
Lowest premium.
But it's kind of nice. It's kind of nice that Mr.
Term
Valentine
policy for the greatest amount.
explains that, because I was going to be looking for the cheapest, not thinking that the cheap is compared with greatest.
It says greatest amount of coverage for the lowest
premium.
Okay.
Yeah. But it's term.
Let's look at the question again, please.
Oh, sorry. Sorry. Mr. Des, can you read this one?
Okay. Which of the following is the key distinction between variable whole life and variable universal life products? What is the key distinction? Variable.
Is it B? I'm not sure.
Now, variable.
Life allows.
Variable is not an endowment, right?
No, variable it just means they take part of your premium and they invest it directly into the stock market.
Stock market, yeah.
But variable does have a distinction that it has to be regulated by FINRA, right?
Variable has to be,
yes.
Both of them are variable, so both of them are going to be regulated by FINRA.
FINRA, yes.
What about B?
B, that's what I'm doing for too. Whole life allows policy loans from cash value.
Both of them, I think, allow policy loans from the cash value.
Both, right?
Both of them do.
And both
I
guarantee.
that both have flexible premium.
I do believe that I'm tilting towards D.
No, I don't know if universal life products guarantee death benefits. Whole life does.
The answer is either going to be A or C.
A or C?
Yes. Universal life, excuse me, universal life is a flexible premium policy. However, I don't know if variable universal life is premium, but there's another thing also about variable whole life.
And since we're not sure in this one, let's choose one and see what it's going to be.
Let's go with C and D.
C.
And that's correct.
I've seen it before, so.
So the key here to understand is that variable whether it's variable life or variable whole life, they all have a guaranteed death benefit.
Okay.
Because the reason is that the portion of the premium that is going to pay for the death benefit is like a term. So that death benefit doesn't change. What fluctuates is the fluctuations in the investment from the portion that is taken and invested. Ms. Geraldine, you want to read this one?
An annuity owner is funding an annuity that will supplement her retirement. Because she does not know what effect inflation may have on her retirement dollars, she would like a return that will equal the performance of the standard and Poor's 500 index. She will likely purchase
equity index annuity.
Correct. Equity index annuity.
Oh, very good.
Yep.
Let me look at the question again, please.
Let me know when you're done.
Okay. Okay, I can see now the question with this, the question about Standard and the explanation about Standard and Poor.
Correct.
Makes it more
understandable.
Yes.
All right. Ms. Ebuko Nooloa, you want to read this one?
Yes. Which of the following types of policies allows the policy owner to skip premium payments, provided that there is enough cash value in the policy to cover the premium amount?
Universal life.
Universal life,
Universal.
right?
Correct. All right. Let's submit. I messed it up with 93%.
Which one did we miss?
The one regarding the annuity, pure life with guaranteed minimum.
Okay, so okay.
All right, we're gonna do 3 sets of questions in this chapter so that we can exhaust as many questions in the question bank as possible. And then we'll go to the next chapter and we'll do the same. Starting this chapter, Miss Karen, are you there? Miss Vera, are you there?
What characteristics makes whole life permanent protection?
Okay.
Living benefits.
Page 100.
I want to say
I
D.
think it's D.
D.
Coverage to
D
death,
is
yeah.
coverage
It should be
until
D.
death of one.
Correct.
I think the
Coverage
answer is D.
until death. Yeah. Correct. Next one, Miss Lola, you want to read this one?
Which of the following is another term for the accumulation period of an annuity? Pay-in period.
Correct.
Yes.
Paying period, growth period, accumulation period all mean the same thing.
Oh, hold on. Let me repeat that again.
Which of the following is another?
Mr. Valentine, you said a pay-in period,
I said
accumulation,
pay-in
and
period, growth period, accumulation period, all of them are the same thing.
okay.
Ms. Geraldine, you want to read this one?
Level term insurance provides a level death benefit and a level premium during the policy term. If the policy renews at the end of a specific period of time, the policy premium will be determined adjusted to the
Adjusted to the
insurance
short age at the time of renewal.
at the
That's
time
true.
of renewal.
Yes.
Attained age.
Attained age, yes.
Correct. If you are not reading, follow up the question very closely because that's how we'll learn best. So I like the people who are following up and trying to answer, even if there's somebody else is reading. So I like that. All right. Question 4 of 15, Ms. Ebukun Nolowa. You want to read this one?
Yes. Which of the following best defines target premium in a universal life policy? Target premium.
The maximum amount the policy owner may pay on the policy.
Or the recommended.
That is 7 pay. The maximum
C.
amount.
Pay.
The recommended amount.
It should be C.
Okay. Okay, recommended. That's
Correct.
That's okay.
So the number A is 7 pay. Okay. The maximum amount the policy may pay on the policy. Okay. Okay, that's true. 7 day. Yes,
Okay.
C is the answer.
See.
That's correct.
Yeah.
Miss Lola, you want to read this one?
Yeah, cool. Fixed annuities provide all the following except
Fix. Oh, except. Doesn't provide hedge against inflation.
Correct.
Okay, that's true.
Except.
An index annuity might provide a hedge against inflation. A variable annuity might provide a hedge against inflation, but not a fixed annuity because the interest rate is fixed. Let's say it's 4.75 and inflation is 9%. It will not, inflation will outpace the growth in the fixed annuity. Number 6, Ms. Ebukun Nolowa, you want to read this one?
Yeah. The insured is also the policy owner of a whole life policy. What age must the insured attain in order to receive the policy face amount? 65. Oh, is it 65? Oh, 100. 100.
All right.
100. Face amount is the same thing as death benefit.
That's correct. 100. Next one, Ms. Geraldine, you want to read this one?
Which of the following products require a security license?
Variable. B.
Security is variable.
Yeah.
Correct. Anytime you see variable, you know it needs a securities license. Ms. Lola, you want to read this one?
A universal life insurance policy is best described as
Is it a flexible premium?
Universal. Universal, isn't universal whole life?
Yeah, it's not whole life, but it has some features, similarities with whole life.
Flexible premium.
Flexible premium variable life policy.
It's not a variable life policy.
Oh, okay.
Variable life policy would mean the portion of the premiums are invested directly like in the stock market. But
yes.
Universal life is not.
Is it D?
Is it D?
Is it
Correct.
annually renewable?
Annually, cram that answer, because you'll probably see in the exam. Annually renewable term with a cash account. Because the death benefit in the universal life is fixed. So that's the term. And then part of your premiums are used as investments. That is your cash account. So a universal life policy is an annually renewable term with a cash account.
And this is different from IUL, correct? IUL is Index Universal, or is it is a different product?
It's the same thing.
It's a similar.
It's just that the IUL specifies that the money in your cash account is invested in an index fund.
Okay.
Yeah. Ms. Vera, you want to read this one?
If an individual wants both protection and savings from their insurance and is willing to pay premiums until retirement at age 65, what would be the right policy for this individual?
Is it D?
Wait, period. Yeah, D.
Or C?
Life annuity with period setting.
Protection and savings.
Protection and savings, and is willing to pay premiums until retirement at age 65.
That should be limited life.
Limit pay or
limited pay whole life. The period for paying premiums is limited. Usually, limited whole life will have you pay premiums for either 20 years or age 65, whichever comes first.
Wow.
That's correct.
Okay. Limited pay.
Mr. Oluwatosin, you want to read this one?
Okay, sir. Which of the following is not true regarding the annuitant?
Okay.
I
think it's B.
B, the annuitant cannot be the same person as it.
It's not true.
It can be.
And that's right. But let's pay attention to the attributes of the annuitant. The annuitant is the one that receives benefits from the annuity, true. The annuity must be a natural person. A corporation, a non-profit organization, they cannot be the annuitant. D says the annuitant's life expectancy is taken into consideration for the annuity, true. Because they are the ones who are going to be receiving the payment. Mr. Des, can you read this one? Mr. Desmond, are you there? I know sometimes jet lag gets the best of you.
Okay, maybe I should refine.
Go ahead.
Which of the following is true regarding variable annuities?
A, the annuitant assumes
the risk on investment.
Correct. Okay. Very true. Ms. Lola, you want to read this one?
If the annuitant dies during the accumulation period, who will receive the annuity benefits? Okay, C, the annuitant's estate.
Don't they have beneficiaries?
The beneficiary.
You want to revise your answer, Ms. Lola?
If the annuitant dies during the accumulation period, is that the paying period?
Correct.
Yeah. The beneficiary.
I still want to take C, but if I'm wrong, that's fine.
Okay.
Let's try D. The beneficiary.
So it's sometimes
The annuitant's estate receives only if the beneficiary dies before the annuitant dies.
okay.
So you have an annuity, you have an owner, you have an annuitant, the person who will receive payments from the annuity, you have a beneficiary. So the beneficiary is supposed to receive if the annuitant has not received everything that they are supposed to receive. However, if the beneficiary dies before the annuitant receives everything that they are supposed to receive, it will go to the annuitant's estate. All right.
That's good. Sorry, I was out of in when the question was asked. I'm sorry. Let's look at that question again, please. I didn't quite get it.
Go ahead. Welcome to class, Miss Blanding.
If that is the dice,
thank you, everyone.
Receive that. Sure, that's beneficiary. Correct. Okay, I got it now. Thank you.
All right. Question 13. Ms. Oluwatosin, you want to read this one?
Yes, sir. An insured purchased a life insurance policy. The agent told him that depending upon the company's investment and expense factors, the cash values could change from those shown in the policy at issue time. The policy is an adjustable life.
If it could change, yes, it can be adjustable.
No, interest sensitive whole life, I think. Interest sensitive, because it's changing from.
All right, so let me tell you how you distinguish to get to the answer. You answer this by elimination. Annual renewable term is a term policy, so it doesn't accumulate cash. We junk that. Credit life is a decreasing term. It doesn't accumulate cash. We junk that. Adjustable life is a term policy. The only policy here that grows cash is interest sensitive whole life. And they say, depending on the company's investments and expense factors, the cash values could change from time to time, different from those that are shown on the policy illustration at issue. Interest sensitive whole life. Correct.
That's experience speaking there.
Thank you. Ms. Blanding, can you read this one? You read just the question. If Ms. Blanding is not ready, Ms. Geraldine, can you read this one?
All of the following are true regarding the convertibility option under a term life insurance policy, except.
I want to go with D.
Upon conversion, the death benefit of the permanent policy will be reduced by 50.
Yeah, that's the except.
That's except.
That's correct. Number 15, Ms. Oluwatosin, Ms. Ebukun Nolowa, you want to read this one?
Okay. Which of the following types of policies will provide permanent protection?
Whole B.
Correct. I like to give you 100%. Good job, guys. One more on this chapter. You guys saw that all of the questions we got during the second try were totally different from the first, right?
Yes.
Yes.
All right. Let's go back and do one more. Get more questions from that their question bank. Miss Vera, you want to start with this one?
When an annuity is written, whose life expectancy is taken into account?
The owner.
The owner.
Annuitant.
The annuitant.
Oh, annuitant, I'm sorry. Annuity, not the insurer,
How is
right?
it different from the owner? How is an annuitant different from the owner?
All right. So, Miss Ebuku Noloa, when you write an annuity, right? An annuity has an owner. The owner is the person who brings money to create the annuity. The owner can be the annuitant, which means that owner can write that annuity for the benefit of themselves, but not necessarily. You can have a husband who writes an annuity, who is the owner, but writes the annuity for the benefit of the spouse.
Who is the
going to be the
annuitant? Okay.
Can be for the benefit of their son.
Okay.
Who is going to be the annuitant. So when an annuity is written, whose life expectancy is taken into consideration? The person whose life expectancy is taken into consideration is going to be the annuitant, because that is the person who is going to be receiving the payments. So they have to find out what their life expectancy, so that they know how much to pay them monthly or yearly.
Okay. Yeah. Huh? The annuitant.
Yes. You need any clarification?
I am in sync with it now.
All right.
Because what threw me out there is the distinction between the owner and the annuitant. But now it's clearer. Thank you.
All right. Good. All right. So next one, Mr. Des, can you read this one?
Which type of life insurance policy generates immediate cash value? Immediate cash value would be single premium.
Excellent. Correct. Mr. Oluwatosin, you want to read this one?
Okay, sir. What kind of policy allows withdrawals or partial surrenders?
Universal.
Universal life, yeah.
I have a tendency to fail this one every time going to 20-pay life, forgetting the universal life.
Now you stand corrected. Number 4, Miss Geraldine, you want to read this one? Miss Geraldine, are you there?
It is Standard & Poor, 500.
Miss Awe. Hey. Miss Awe, can you read this one?
The current interest rate on an equity index annuity is often based on A. I think it's A, an index SP 500.
Yes. Yeah. I didn't even read it. I
can't read it very well because it's not clear on my side.
It's one of those low-hanging fruits.
Very true. Whoever is eating, bon appetit. Miss Lola, can you read this one?
Which of the following features of the index whole life policy is not fixed? Cash value growth.
Cash value growth. B. Yes.
B.
B.
The Valentine, do you have alternative?
No.
Oh, you like that uploading too? You guys are crazy.
I'll box it.
Oh, really?
They're gonna beat me up very badly.
Let me get you.
All right. Ms. Ebuko Nolowa, you want to read this?
Yeah. Which of the following life insurance policies allows a policy owner to take out a loan from the policy's cash value? Variable life, variable universal life.
Everything else is term.
Yeah.
All right. We come back to Miss Florence, if you're there. Can you read this one?
The annuitants die while the annuity is still in accumulation stage. Which of the following is true? The owner estate will receive the money paid into on the annuity. The money will continue to grow
Miss Florence, we read just the question and we let each person read the answer and figure it out.
See the answer.
The benefits will receive the greater
beneficiary. Yeah, that's it.
annuity or cash value.
Correct.
We've seen that twice now.
Yes.
Or 3 times.
So we'll not miss it. We'll not miss it in the exam. Miss Florence, you want to read this one again?
Who bear all the investment risk in fixed annuity?
The
insurance company.
The insurance company.
The insurance. Oh.
Miss Florence, remember it's a fixed annuity.
Not variable.
Fixed annuity, yes.
So it's the insurance company.
The annuitant will or the owner will.
Insurance company. That's
the insurance company will, yes.
Okay.
Because they have set a price on which the interest they will pay him.
Correct.
Yeah.
Miss Geraldine, you want to read this one?
An agent selling variable annuities must be registered with FINRA.
Correct. Number 10, Miss Awake. Miss Awe, can you read this one again?
Which of the following has the right to convert the existing term coverage to permanent insurance? That's the policy owner.
A.
A.
Yeah.
These are some of the rights of the policy owner.
Yep.
Correct. 11 of 15. Miss Karen, if you are there, can you read this one? Mr. Desmond, can you read this one?
Which of the following is not true about a joint and survivor annuity benefit option?
A.
Yes.
A.
A.
A is talking about joint life, not joint and survivor. Yes. Number 12, Mr. Oluwatosin, you want to read this one?
What's the purpose of establishing a target premium for a universal life policy?
C, to keep the policy in force.
In force, yes.
Seeing you for the second time.
Keep the policy in force.
Ms. Ebuko Nolowa, you want to read this one?
Which policy component decreases in decreasing term insurance?
Good question.
A.
Face amount.
I'm so excited. You guys are going to pass this exam like there's no tomorrow.
There is tomorrow.
Miss Lola, you want to read this one?
Okay. If the owner of a whole life policy, who is also the insured, dies at age 80, and there are no outstanding loans of the policy, What portion of the death benefit will be paid to the beneficiary? That should be full debt.
Full benefits.
Benefit.
Yeah.
Full debt.
Totally impressed.
All things being equal.
Number 15. Miss Lawrence, you want to read this one?
Which of the following is true regarding the premium in term policy?
C.
The premium is level with the time of the policy.
Correct. Submit 100%.
Wow. That's great.
I wish that when we get to that exam, we can score 100.
You will score. You guys are very ready. Over the next 2 weeks, we're going to get a lot of pass scores.
Amen.
And I'm excited. Let's go to chapter 3.
Oh, I thought you said we're going to have the exam something for that. Or is it no now?
That we're going to have what?
Like the exam. I thought we're going to have not the quiz now, but the exam itself, the practice exam.
The readiness exam.
Yeah.
Oh no, we'll have it on Wednesday.
Okay.
Yes. Again, when we're drilling into the chapters, we are reaching all the available questions that they can ask. So we're going to do three sets of questions here, so that we see all angles that they can ask.
Okay.
Miss Ebuko Nolowa, you want to read this one?
Yes. All of the following are non-forfeiture options except non-forfeiture options.
Interest only. No. Interest only.
That's the one that looks odd.
Yeah.
Correct.
Yes. Interest only. That's why investing there paid out.
But let's just look at the other, what the non-forfeiture options are. Cash surrender,
Yes,
reduced paid up, extended term. There's one that is missing. What is the one that is missing? Paid up.
Reduced paid up. Reduced, okay.
Reduced paid up is there. But paid up is the other one.
Paid up time, yes.
Two of 15. Miss Lola, you want to read this one?
According to the entire contract provision, what document must be made part of the insurance policy? C. Copy of
Yes.
Correct. Miss Vera, you want to read this one?
Which of the following riders would not increase the death benefit?
D.
Benefit rider.
Your benefit rider.
If anybody does not understand why is the answer, stop us and we'll explain.
Explain, please.
All right. Accidental death rider is called a double or triple indemnity rider, which means if you have the accidental death benefit rider, if you die as a result of an accident, they'll pay you either 2 or 3 times your death benefit. So that will increase your death benefit. Cost of living rider is an inflation rider that is pegged to the CPI, the Consumer Price Index. So if at the time of your death, inflation has increased the cost of living, then they will adjust your death benefit to what the cost of living is. That will increase your death benefit. guaranteed insurability rider. Guaranteed insurability rider says at a certain age or before a certain age, you can increase your death benefit or apply with the company to increase your death benefit without showing proof of insurability. That has the potential to increase your death benefit. So the one we are selecting is pay your benefit rider. What is pay your benefit rider? It just says if the insured, well, not the insured, if the owner and who is the payer becomes disabled, the company will take over payments of the premiums until they become well, or until the insured reaches, say, the age of some states 21, some states 18, and they can go get their own policy. So the payer benefit rider will not increase the death benefit. Is that clear?
Yes, sir.
All right. 4 of 15. Ms. Ebuku Nolowa, you want to read this one?
Yes. In a case where the primary beneficiary predeceases the insured, in the event of the insured's death, the death benefit proceeds will be paid to
Contingent
contingent
beneficiary.
contingent
beneficiary. Contingent beneficiary. Which is right. Next question. Mr. Des, you want to read this question?
Which of the following information will be stated in the consideration clause of life insurance policy?
Amount of premium payment.
Will be stated.
Amount of premium payment.
Correct.
The amount of that's consideration.
Yes. Remember, consideration, there are two considerations that are offered by the client or the insured. One, payment of premium, and two, the facts stated on the application are also seen on as consideration.
Payment of the premium, yes.
All right. Ms. Lola, you want to read this one?
Which of the following allows the insurer to receive a minor insured from premium payment if the minor's parents have died or become disabled?
Payers premium.
No.
Juvenile premium provision.
Okay.
But we would like to read the question.
Of premium. To relieve mine.
Is it the C?
I think juvenile premium provision.
Yes.
Juvenile.
So if that is the case, what is the payer benefit?
Payer benefits allows to be add the juvenile into the policy.
Now the payer benefit will relieve the juvenile of premium payments.
Mm-hmm.
If the minor's parents who happen to be the payer have died or become disabled.
That's true.
That's true.
Which is correct.
What does juvenile do then?
It's meant to throw us off.
Yeah. These people better be careful.
I prefer for it. So we talk about the payer benefits.
You just have to understand the definition of payer benefit and premium waiver to answer that question. Ms. Blandin, if you are available to read, can you read this one?
The Valentine, you need to go warn these people for us. So.
I've taken that assignment and I'll deliver it. Miss Florence, if you are there, can you read this one?
All of the following statements concerning dividend are true, except
All of them not true, but I think they are not guaranteed. That which is B. Dividend amounts are never guaranteed.
are not guaranteed.
Yes, true. That's correct.
Amounts are not guaranteed in a policy. Yep.
True. Oh, I didn't submit it, but that's correct.
Mr. Valentine, we are going too fast for folks with the kind of brain some of us have. We're going too fast in this. Let's slow a little bit, please. I can't see the fast is going. As a head injury person, I can't even dare to read anything. I don't even read, and then somebody answers the question.
That's okay. You can always go back and watch the video.
No, yeah, that's why he has to pause a little bit at the end of the answer, because I must look at the answer.
Yeah, that's
right.
And see why it is.
Okay.
At the end.
Yeah, we can all learn.
Correct.
Yeah, right.
You know what happens when I went to college, right?
Yes.
Everybody will be there. They don't understand the thing, and they will just rush and rush. And I say head injury. I will tell the professor, stop, man. Hold on. I do know when every cylinder was firing in my brain, I used to be able to get the answer fast and quick. Slow down a little bit, and they say, okay, there's this here. Let's look for him.
All right.
And they allowed me to finish school. I would have, I was a dropout already when I was shot in the head. I flunked and stayed off for many years before I picked up the courage to say that I'm going to go to school. Don't worry about it. This shows the work of God, my brothers and sisters.
Amen. Amen.
Praise God.
Yes. So we are glad you stuck to it. Miss Geraldine, you want to read this one?
Which of the following explains the policy owner's right to change beneficiaries, choose benefit payments option, and assign the policy?
Right.
I think it's C.
Entire contract provision.
The entire contract, yes.
No, owner's right.
The owner's right.
Correct.
Owner's right to change and choose.
Remember, all of these are describing the owner's rights. Right to change beneficiaries, right to choose benefit payment options, the right to assign the policies, the right to revoke a revocable beneficiary, the right to take policy loans on the policy. All of those are owner's rights.
Yes.
Wow.
Wow. Look at how they brought all of the same thing together.
Miss Awe, can you read this one?
The accelerated benefit provision will provide for an early payment of the death benefit when the insured
becomes terminally ill.
Correct.
Okay.
Terminal illness, chronic illness, critical illness will trigger the accelerated benefits. Question 10. Miss Ebukun Nolowa, you want to read this one?
Yes. When may an insurance company use suicide as a defense against paying a death claim?
When a death occurs within a specified period of time after the policy was issued.
Within 2 days, within 2 years, other 2 years.
For some states, it's 2 years. For other states, it's 1 year. If suicide occurs within that specified period of time, they will not pay.
Okay. But sometimes they will put the exact year.
Correct.
Then we know it's 2 years. If not, when they say specify, when they say without the years, you know it's specified time.
Correct. Okay. Miss Vera, you want to read this one?
Which of the following policy components contains the company's promise to pay?
Entire contract.
B, the entire contract.
Entire contract provision.
The entire contract provision.
Company. I think insurance clause.
How about insurance clause?
See, I'm also thinking C too.
This one is very close between these two.
It should be the entire contract.
Yes, insurance clause.
Insurance clause.
Insurance clause. Good Lord.
Sure.
Wow.
Let's go back to the question. We need to drill this question in. So which of the following policy components contains the company's promise to pay? So entire contract might also include the insurance clause, but they are drilling down. They are always wanting an answer that is more specific. Insurance contract. Miss Florence, you want to read this one?
Using a class designation for beneficiary means. I think
plus naming beneficiary as a group. D.
Naming it
as a group, I think.
Using class of designation for beneficiary means naming.
We have individual, we have
as a
group, we are under class and group. I don't know. It's look, that's D. That's what I'm thinking.
It's between A and D.
A, not naming beneficiaries.
I think it's D.
No, should be
I'll go with your answer D and let's see.
Group.
Okay.
Except they want to do it.
Do.
Correct.
This is correct.
Mr. Valentine, explain this question, please.
Class designation means you are not naming individuals as beneficiaries to this policy. You can say all my children.
Okay.
And all my children, grandchildren, and great-grandchildren. That is a class. Okay. Or you can call it a group. So some of those grandchildren have not been born yet, so you cannot put them by name.
Can I ask a question?
Go ahead.
Won't this create trouble when that time comes?
No, it will not.
Or would they appoint what do you call it?
A trustee.
A trustee, yes.
Usually a trustee manages something like this. But as a lawyer, let me tell you when this will create trouble. Is if you had some children that you did not know you had.
My God. Mr. Valentine, we are throwing some of us in trouble now, huh?
Or you have some children you know you have, but your spouse does not know you have.
You know you have. That's true.
Well, sometimes you might have some children that you don't know you have. Only the mother knows.
That's why I say like MK now. Also, the woman will wait till the burial ground, they not come, and there's no denial.
when in the reading of the will, the children show up.
Oh my gosh.
This is why what you did as a young man will come to haunt you.
And all they need to do is go do a paternity test.
With a dead man?
Mr. Desmond, the men went only when they are young, some even do it in their old age.
God bless you, my sister. That's what I wanted to say, but I said, let me keep quiet. They're in a class.
My beloved sisters, now that I'm old, I know what I'm supposed to do and what I'm not supposed to do. To the glory of God, unless they drug me and tranquilize me, I didn't know where I am.
So men are still not wise as you are. God will help them.
It's not being wise, it's a choice. Can a man, the scripture says, can a man put fire in his bosom without being born?
Oh my
I've
goodness.
made my choice, and you know, I did my stupidity when I was younger. Thank God it's not now.
Amen. 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 Miss Geraldine, you want to read this one?
Before I read, the answer is A. Which of the following is true about the premium of the children's rider in a life insurance policy? Is A.
You have overread this one. You just go straight to the answer. Oh my God.
Very true. Everybody should pay attention to this answer. Remember, when you get asked in the exam, irrespective of how many children you have, it doesn't change the cost of the children's rider.
Uh-huh.
Yes.
Correct. Miss Ebuku Nolowa, you want to read this one?
Yes. Which of the following, when attached to a permanent life insurance policy, allows the policy owner to customize the policy to provide an additional amount of temporary insurance on the insured, or allows amounts of temporary insurance to cover other family members? Is it B or C?
C? I don't know. It looks like C. Stem rider.
Stem rider is temporary.
Stem rider. Oh, temporary insurance. Okay, stem rider.
Correct. Mr. Des, can you read this one?
The policy owner pays for her life insurance annually. Until now, she has collected no taxable dividend check each year. She has decided that she would rather use the dividend to help her pay for her next premium. What option would allow her to do this?
Premium.
What option? Wasn't it be
reduction of premium?
C. Reduction of premium.
Reduction of premium.
Correct. That's the settlement option.
Mm-hmm.
Or rather, a known forfeiture option.
Non-forfeiture. Use the units. Wow. We'll ask this one again, huh?
Correct. So I'll do a last one on this. Okay. Let's start with Miss Awe.
What is the term for how frequently a policy owner is required to pay the policy premium?
Schedule.
Schedule. Is it mode? Mode of payment, yes. Mode of payment.
Payment.
Yes.
Oh, Jesus.
Remember, the schedule of payment premium is called the mode. Can either be monthly, quarterly, yearly, bi-weekly. It's called mode.
Why do they make the same word saying the same thing? And yet they would choose the one that is more appropriate.
That's a very good question. Miss Lola, you want to read this one?
Right. When attached to a permanent life insurance policy, provides an amount of insurance on every family member.
Family term rider.
Term rider?
Yes.
Correct.
Family term
Mr. Oluwatosin, you want to read this one?
When the insured selects the extend term non-official option, the cash value will be used to purchase term insurance with what face amount?
C, equal to the original policy for as long as the cash values we purchase.
Hey, my sister is ready. Oh.
Hello. Let's see what that
Okay, yes.
Yep.
Yes.
Correct.
Hold on. Let's see the
Let's read the
answer.
question again, please.
There you go.
Okay.
Come up to the explanation of the answer, please.
Okay. Let me know when you're ready.
Thank you, sir.
All right.
Bless you. Good. Go ahead, sir.
Ms. Ebuko Nolowa, you want to read this one?
Yes. Non-forfeiture values guarantee which of the following for the policy owner?
Non-forfeiture.
A,
Hey.
cash value will not be lost.
Right. All right, let me run and grab a bottle of water. Miss Vera, read this one. You guys figure out the answer and I'll be right back. And if anybody needs to grab something, let's just, after you guys answer it, let's take a 5 minutes break. So we start at 8:55 or 9:55 for some people. So 5 minutes break. Be right back.
A primary beneficiary of her husband's life policy found that no settlement option stated in the policy on the date of her husband's death. Who will select the settlement option in this case? The beneficiary?
The beneficiary, yes.
Yeah. But it hasn't gone to court yet, right?
No.
Will be the insurance company, which basically probably go to the estate of the family. Right?
The primary beneficiary of her husband's
The primary
life
beneficiary.
policy
So
found
the
that
insurance
no settlement option was stated in the policy on the date of her husband's death.
I'll be the beneficiary.
Who will select the
because
settlement
Will be the
option?
insurance company.
I think if he has no
Possible.
beneficiary, then the insurance company can
They can decide, but
Yeah.
he has a beneficiary.
What if he has gone to the court now?
What?
There is
What
a
if he has gone to the court?
beneficiary. Because
It
there is
didn't
a
state.
beneficiary.
It didn't state if they went to the
Then
court.
if life insurance to go to probate court. Yeah.
Okay.
We could be A too, because it's
Yes, benefits will be paid in a lump sum.
in a lump sum.
That's
Since
a
you select an
settlement.
option.
Yeah. Yes, that's a settlement actually.
Oh.
Yeah.
That's true.
Since they didn't choose you, they'll just give the.
It's tricky.
So
the
very
yes,
tricky.
beneficiary,
yeah.
yeah, but the beneficiary can decide to how he wants the money to be paid. So that's
So
why it's
since it
tricky.
wasn't stated, it should be given in the lump sum.
Okay, the jury has gone out. Let's see what the judge says.
So,
These people, their goal is just to confuse people's life.
Wow.
Oh.
Things are getting messy. The Love Island games.
All right, are we ready?
There will be consensus for the beneficiary.
Let's say A, the beneficiary.
We said A.
Who will
A.
select this?
Okay, I'm sorry, but I think it's B.
Well, just go with B. Let's see. It's a very tricky question.
They said who we select. They didn't say A answers the benefit must be paid. But who is the question? Who will select the settlement option? That's the question.
Beneficiary.
So it should be a... I'm sorry, I thought you said but I'm sorry.
Beneficiary. Okay.
The beneficiary.
That's what was said earlier.
Mr. Des, you want to read this one? Welcome to class, Lady Bloomer, Dr. Bloomer.
Thank you, SMD Valentine. I appreciate you.
Yes. We are rejuvenated by your smile. So
thank you. Thank you.
You're welcome. Yes. So Miss Lola, can you read this one?
Okay. If a life policy allows the policy owner to make periodic additions to the face amount at standard rates without proving insurability, the policy includes A.
Correct. A guaranteed insurability rider.
That's true. Additional, yeah.
Miss Blandin, if you are there, can you read this one? Miss Vera, can you read this one? Vera, oh, Vera, go get your moolah. Wake
All
up.
of the following.
Raleigh, don't mess up with my sister like that.
Go ahead, Vera.
Okay, I'm trying to see. All of the following are true regarding the guarantee, assurability. What's that? Rider, except.
C. I'm not sure.
I think B.
And that is correct. That's correct. The guaranteed insurability rider is one which, if you want to add to your policy, there's going to be an additional premium paid for having that rider. And again, that rider says, if you want to increase the face amount of that policy, you can do that. But that only exists up to a certain age. It might be, say, age 55 or age 60. Up to that age, you can increase the face value of the policy without needing any medical exams done. Mr. Oluwatosin, you want to read this one?
You didn't submit that.
Oh, I didn't submit the previous one?
Yeah. Okay. What happens when a policy is surrendered for its cash value? Yeah, coverage ends and the policy cannot be reinstated.
Correct. The key word there is surrender.
Surrender.
Once you surrender, it's bye-bye.
Yeah.
It's gone. Okay. And let me give you guys an example. I had a client of mine who mistakenly called and surrendered their canceled their policy. Their policy had accumulated cash for about $7,000. They had the policy for 2 years, and they got, I don't know what got into them, they canceled it. If they had waited just for 1 year, they could have been able to surrender that policy for a cash value of about $6,000. So coverage ends and the policy cannot be reinstated. Correct. So remember that surrender means surrender. Ms. Geraldine, can you read this one?
Who can request changes in premium payments, face value, loan, and policy plans? The policy owner.
D. Again, those are rights of the policy owner. Correct. Next question. Ms. Ebukun Nolowa, you want to read this one?
Yes. Which of the following protects the insured from an unintentional policy lapse due to a non-payment of premium?
Premium loan.
Automatic
premium loan, yes.
Automatic premium loan.
Correct. Ms. Awe, you want to read this one?
An insured has had a life insurance policy that he purchased 3 years ago. When he was 40 years old, he is killed in an automobile accident, and it's discovered that he is actually 45 years older and not 43, as stated on the application. What will the company do?
Reduce benefits.
Reduce death benefit.
Correct.
Yeah.
Didn't submit that.
Hold on a second. What's the difference with that question and when it is that when they know that that's a misstated age?
Now, that is it. When they know it's a misstated. Okay, so what happens is that when you write a policy and they discover information that is a material misstatement, okay? If it's within the contestability period, they can cancel the policy and just reduce your premium benefit. So if he died within 2 years, and 2 years is the contestability period, they will just return your premiums and you will not have a policy. They will not pay any death benefit. However, if the 2 years has passed, and again, 2 years is the contestability period, then for any other reason, they will pay the full death benefit. Let's say they asked you on the policy application if you've had any previous critical illness, chronic illness, or any other stuff, and you say, no, I've not had any previous critical illness. Have you had cancer? No. Have you had stroke? No. Have you had heart attack? No. And they don't catch it within 2 years. After 2 years, they will still pay the full death benefit. The only exception when they will adjust the death benefit is misstatement of age. But they will not cancel the policy. They will just reduce the policy to what the death benefit would have been had you stated the right death benefit.
Okay.
I wish I could have put that as part of that answer.
Yes, the answer wasn't there. That's why.
Yes,
that's why.
Reduce death benefit to the attained age.
That's what we usually see. All of a sudden, they throw a. You see, they're into all this, their shenanigans.
I hear you. I hear you. Des, you want to go ahead and read this one?
If an insured withdraws a portion of the face amount in the form of accelerated benefits because of a terminal illness, how will that affect the payable death benefit from the policy? Okay. If the
debt benefit,
the debt benefit will be smaller.
B.
B.
Hold on, the debt benefit will be no. Yeah, it will be smaller. But this is all the questions that are going away from the conventional questions we used to know.
Because we are drilling down 2 or 3 sets deeper.
My goodness, these people are something else.
Yeah. And that's why we're doing 2 or 3 times the 15 questions, because when you do the first set, the second set, then they don't have any more questions to ask you. So by the time we do the 3 sets, we've already exhausted the possible questions that they have in their question bank.
Excellent.
Yeah.
Okay.
Correct. All right. Next one here, Mr. Oluwatosin, you want to read this one?
Yes, sir. When a reduced paid up non-forfeiture option is chosen, what happened to the face amount of the policy? It remains the same as the original policy. Reduced paid up, yeah. Thank you. I think it's it reduces the amount of what the cash policy will buy as a single premium.
Correct.
Yeah. It reduces it.
Remember, the non-forfeiture options again are extended term, paid up, reduced paid up, and cash surrender. Miss Lola, you want to read this one?
At the time the insured purchased a life insurance policy, added a rider that will allow to purchase additional insurance in the future without having to prove insurability. The rider is called
insurability. B.
Guarantee insurance.
Nobody will miss this question in the exam. All right. The last one, Miss Vera, you want to read this one?
Okay. I'm here.
Go ahead, read this last one.
Okay. When a policy owner designates a group of individuals as the beneficiary of a life insurance death benefits without specifically naming the individual, this is called class designation.
Correct. Let's see which one we missed.
I think there was one there that you omitted submitting the answer.
Correct. Let's see.
It was number 7, or maybe.
Oh,
number 7. You did not submit number 7 in
let's
that
go
last
to
second.
Incorrect. It's not showing us the incorrect.
No, it was just missed. It was just
Maybe because we missed it.
Okay.
So we passed, that's fine.
Yeah, so we did not really miss it. It's just that we did not submit it.
You did not submit. The answer was correct. The answer was beneficiary, but it wasn't submitted.
All right. So Let's go to the next chapter now and hit some questions. Again, for those who want to view the lectures, I can forward all the recorded lectures.
Please.
Yeah. So. All right. So we're going to do 2 or 3 sets here before we call it a night. Question 1 of 15. Ms. Geraldine, you want to read this one?
Social Security was created to provide all of the following benefits except
B.
B, unemployment income.
A.
It's A. Survival benefits, yes.
Which one do we say is the answer?
Except.
Except
unemployment income. Except unemployment
A.
income.
It's survivor's benefit.
It's survivor's benefit because when it doesn't pay. If somebody dies, you take over their social security.
All right, Miss J. If you die, if somebody dies and their child is still below 18, that child will collect their social security.
Yep.
Okay, what about unemployment income?
That's called survivor's benefit. Or let me explain something else. Or if somebody dies, and their spouse is above 62, and their spouse had income in their lifetime that was less than their deceased spouse, they will not collect their own social security, they will collect the social security of their deceased spouse. Survivor's benefit. Also, for those who want to know if it's of any relevance, if you're married to somebody for 10 years and above, and you're already divorced, and you die, they can still collect your social security. All right. So unemployment income is the exception. Social Security pays disability income, it pays retirement income, it doesn't pay unemployment income.
That was the except.
Oh my.
That's the except. Yep.
Okay.
Okay. Next one. Miss Lola, you want to read this one?
Which of the following is the required number of participants in a contributory group plan?
Okay.
300 or 75? This was confused. I think
everybody should participate.
75.
Okay, so it's contributory. Okay.
Remember, just remember it this way. Miss Lola, just remember it this way. If the company is paying for everything, which means non-contributory, there's no reason not to cover everybody.
It's going to be 100. Okay.
So it's going to be 100. But this one is contributory, meaning people who participate are paying
premium.
Who pay to it are contributing.
So that should be 75%.
Correct.
Thank you for the analysis. Now I won't forget. I want to say that.
You're welcome. All right. Miss Florence, if you're there, can you read this one?
All of the following are examples of third-party ownership of a life insurance policy, except
Third party.
Between, I
Would
think
that be
between
G?
B and D.
B.
B.
Pardon?
B.
Okay. The right answer has a trick in it. And for you to pick the right answer, you have to understand the difference between absolute assignment and collateral assignment. Now, the question says, all of the following are examples of third-party ownership. The key word there is ownership. In an absolute assignment, say you own a policy with the face value worth, say, $1 million, and you go borrow, say, $1 million from the bank, you assign the entire $1 million, so you transfer ownership. That is called an absolute assignment. However, if you own $1 million policy and you go borrow $200,000 from the bank, and you assign the bank only a portion of the $1 million, then that is not a transfer of ownership. You still own the policy, but there's a collateral assignment. So with what I've explained, what is the answer?
D. D.
That's correct. Okay. Question 4 here. Let's go to Miss Awe.
In order to qualify for conversion from a group life policy that has been terminated to an individual policy of the same coverage, a person must have been insured under the group plan for how many years?
Yes.
1 year.
Okay.
It's an interesting
Is
one.
You have
it
annual
3?
renewable.
Is it 3 years?
Insurance. How many?
5 years.
It's 5 years.
I'm not
Okay.
sure.
Let's pick one and we'll learn. I'm not sure what the answer is here. Let's pick one and one. It's either going to be 3 or 5.
I
It's
think
5 years.
5 years.
5 years.
I'm not sure.
Or even 3. I'm not sure.
Let's see.
Right now.
Let's see.
Okay.
5 years.
Good.
All right. So the way to understand this, or the way to understand why they are choosing 5 years here, okay, is that for most benefits, for example, your 401k plan, pension plan with the company, 403,
yeah, I remember now.
You are vested for 20% each year.
Yes.
Vesting is 20% each year. So for you to be fully vested in that benefit, 20% first, 20% second, 20% third, so 100% will be 5 years. So let's say you have a 401k plan and the company matches. If you leave after the second year, you can only take 40% of that match. They will not give you 100% of the match that you've earned. You need 5 years to be fully vested. All right, let's go to the next one. Mr. Oluwatosin, you want to read this one?
Okay, sir. A life insurance policy used for fund an agreement that contractually establishes the intent of someone to purchase a business upon the insured business owner's death is buy and sell agreement.
Buy-sell agreement.
Buy-sell agreement. Yeah.
Yes. But remember, if they had said upon the owner's death or disability, then would have been disability buy-sell agreement. But it's just upon the owner's death or the insured's death is going to be buy-sell agreement. That's correct. Miss Vera, you want to read this one?
All of the following statements are true regarding tax qualified annuities, except contributions. Employers' contributions are not tax deductible. They are tax deductible.
Yes.
I think the A.
Okay.
Employer contributions are not tax
Or not tax deductible, yeah.
Except.
Yes, correct. You're right.
Yeah,
It's
A.
Yes.
Correct. And we know those contributions are tax deductible.
Yeah, tax deductible.
Correct. Number 7, Miss Florence, you want to read this one?
The minimum number of credits required for partially insured status for Social Security disability is
40 credits.
It's 40.
40
credits. Yeah.
I think it just explained
A
that.
Social Security disability benefit.
Okay.
I think it's the minimum.
It's going to be either, well, the minimum number of credits required for Social Security.
Minimum.
Social Security is 40.
6. But Social Security disability, I think you guys are right, is 40. Let's see if you guys are right.
6.
Credits.
We switched it around.
Yes.
Good.
Let us look at that question very well.
Okay.
Partially insured.
Yes. So partially insured, whether it's Social Security or Social Security disability, it's 6 credits. Yep.
Okay.
Fully insured is 40.
Okay.
What are they asking us now?
Partially insured.
Partially insured, yes. 6.
Okay. Ms. Blandine, if you are there, can you read this?
All of the following are characteristics of a group life insurance plan, except
I think it's B.
There is a requirement to prove insurability. There is no requirement.
There is no requirement.
Except the person is registering out of the enrollment period.
you're right.
And just to stretch your mind, when might there be a requirement to prove insurability?
When the person is registered,
when the
enrollment.
Correct.
Over.
When you're enrolling after the open enrollment period. Very true. Ms. Ebukun Nolowa, you want to read this one?
Yes. An employee quits her job where she has a balance of $10,000 in her qualified plan. If she decides to do a direct transfer from her plan to a traditional IRA, how much will be transferred from one plan administrator to another? And what is the tax consequence of a direct transfer? There is no consequence, it's A.
Okay. She shot right to the answer. So if she's transferring from one qualified plan to another, it is not seen as a distribution. There's no tax consequence. Very true.
Yes.
Mr. Desmond, you want to read this one?
When an employee terminates coverage under a group insurance policy, coverage continues in force for 60 days.
31 days. 31 days.
All right.
31 days?
Yes.
31.
Correct.
Isn't that Cobra?
Group insurance.
Oh, group insurance.
Insurance.
Oh,
Group
Jesus.
insurance.
Why don't I think for this one? Okay, the group insurance is different from, isn't it the same thing, coverage under Cobra?
So when an employee terminates coverage under a group insurance policy. So here we are inferring or deducing that they're talking about a group life insurance policy.
Oh, not, okay.
Not health. Health Cobra would be, I think, likely 60 days or so. So we are deducing that they're talking about life insurance. So let's see. That's true. Miss Geraldine, you want to read this one?
Which of the following is true for a qualified plan?
I think it's A.
Think again.
Not sure.
Cannot discriminate in
So
favor of
that's the
highly
key.
paid employees because let's say they say the match is 5%. 5% for janitors, same thing as 5% for supervisors, same thing with 5% for CEOs.
Oh, okay. It's the unqualified one. Yeah.
Correct.
Sorry.
The tax benefit for both employer and employee. B.
Okay, B.
Correct.
Tax
B
benefit.
is the right one.
It's only tax benefit for the employer.
For the employer, yes, their contributions to the plan are deducted in their taxes for that year as expenses. So it helps reduce their taxable revenues or taxable income. For the employee, it's tax deferred. And that's correct.
Yeah.
All right. Miss Lola, can you read this one?
If an insured worker has earned 40 quarters of coverage, the worker's status under Social Security disability is fully insured.
Fully insured.
Very true. Okay. Miss Awe, you want to read this one?
Simple plan required all of the following except
I think it's B.
D.
What about D?
D, not at,
D as in
at
David.
least
Oh,
at least
really?
1,000 employees. That's
No, the number but it's not that
that's
high.
yeah.
no more than 100 employees.
I thought it was 4. Okay.
Yeah.
Between
At least
20 to
1,000
100.
At least 100.
Okay.
Except.
Oh, except. Okay.
Except, okay.
Yes. Oh.
Except. I was going to say, I thought it was, yeah.
Guys, give me just a quick minute. Okay. A simple plan is available to small businesses that employ not more than 100 employees, receiving at least 5,000 in compensation from the employer during the previous year. Okay. Question 14. Ms. Awe, can you read this?
When an employer offers to give an employee a wage increase in the amount of the premium on a new life insurance policy, this is called
executive bonus.
C.
Executive.
Charlie.
No, executive bonus. Electric contract is on equal value.
You guys are ready to go pass this exam. Yeah, when an employer gives an employee a wage increase in the form of a premium on a life insurance policy, this is called, it's an executive bonus. And remember, the executive pays taxes because that is seen as bonus income. So they pay taxes on the money, on the bonus that is received.
That's true.
Last one here. Ms. Blandin, can you read this one?
Yes, I can. One moment. If taken as a lump sum, life insurance proceeds to beneficiaries surpassed. Do I read an answer or anyone can answer?
Yeah, you can answer it. Or anyone can answer too.
I will let anyone answer.
Tax.
I think it's tax deductible.
Hold on, it's D.
Federal income taxation.
Okay.
As you start doing this business, remember, one of the key benefits we educate people about life insurance is that they can pass over wealth to the next generation free of federal income taxes. You grow money in 401k plan, you pay taxes. 403bs, you pay taxes. You grow wealth in real estate, you pay taxes. Grow wealth in stocks, crypto, you pay taxes when you transfer that. The unique instrument that you will not pay any taxes when that wealth transfers to the next generation is life insurance. Correct. 93. So you guys are still acing it. So I know we've been hitting hard for about 2.5 hours, but let's do one more set of questions on this chapter, then we call it a night. Me too, I'm tired of.
Yeah, try it.
So we're gonna go fast, just like Desmond wants us to do. Des, can you start by reading this one?
Which of the following applicants would not qualify for KYOG plan? Someone working for 400. Oh, no. Hold on. I thought KYOG is for those who are working for small employment, right?
I think self-employed.
Self-employed.
Self-employed people.
So someone who is over
self-employed.
25
See,
years.
Yes.
Oh, wow.
Someone who wants.
That's what it describes.
400 hours.
Your plans, I think, are for self-employed individual.
Yeah.
Yes.
So what is the answer? Someone
who works 40 hours per year.
Someone who works for 400 hours per
400
year.
per year. Okay.
Yeah.
How did that change from self-employed to someone who works only 400?
Because they say, let's look at that question again. Which of the following applicants would not qualify for the flow plan?
Okay.
Will not qualify.
Will not qualify.
Correct.
All right.
The person must have worked at least 1,000 hours per year to be eligible. Let's go. Let's go. Ms. Geraldine, you want to read this one?
Which of the following employees insured under a group life plan will be allowed to convert to individual insurance of the same group once the plan is terminated?
Who have been insured under the plan for at least 5 years.
It's D.
Yes.
Okay.
That's what we just learned.
We just learned that D.
D.
All right.
For 5 years.
Yep. Fully vested. Ms. Vera, you want to read this one?
Which of the following is an example of liquidity in a life insurance contract?
The cash value available to the policy owner.
Very true. Liquidity in a life insurance policy, cash value available to the policy owner. You can withdraw it, you can take loans, it's yours.
You see all the variation here. I thought liquidity in it for the ability to be able to pay.
That ability to pay you're talking about, now you're talking about non-forfeiture options. What are the options available for you not to lose that cash?
Hold on. I think I'm missing something that is in my mind here. You know, the ability of the liquidity of an insurance company to be able to pay the policy. Do you think you understand where I'm coming from?
No, they didn't say the insurance company, they say contract.
Okay, the liquidity. Okay,
is an example of liquidity in a life insurance contract.
Okay.
Correct. If he had said life insurance company, then you'll be right. Like savings account, all of that, yes. Ms. Awe, can you read this one for us? If not, Mr. Oluwatosin, you want to read this one for us?
Okay, sir. The premiums paid by the employer in a business life insurance are
Tax deductible. Never. Tax deductible by the employer. Yeah. I muted. That's why I'm sorry.
All right. So let's see. Tax deductible by the employer, never tax deductible to the employee.
Like paid by the employer.
Are they tax deductible?
Only taxable to the employee.
To the employer.
The employer, I think, is a business expense.
It's not. It's a business expense to the
so it's
employer.
tax.
It's not tax deductible for the employer.
Let me read
employee.
this out.
Which means it's taxable to the employee. Oh no.
Tax deductible by the employee. No.
So it's A. I don't know. I was looking.
Never taxable to the employee.
How is it tax deductible by the employee?
I think that's the answer.
It's business expense.
I think
it's a business expense. Never taxable to the employee.
Correct.
Employee,
I think that's the answer.
Yeah, never taxable to the employee.
But there's something we want to learn here. Let me click the answer and then I'll tell you an extra fact that we
my
honor them.
God. I'm the employee and his employer. See,
Tax
I got it from the
deductible.
beginning.
Is D.
He's a business expert.
Be all confused. I started
The
thinking, who
guy
is
we thought he
employee,
was tax
employer?
expert. I was a business expert.
Because I've seen that question before.
Yeah.
Yeah.
I got confused. I started thinking, am I the employee or am I the employer?
All this
Okay.
deductible, I just zoom off. I don't.
All right, we've learned tax deductible by the employer.
Oh yeah.
Miss
Yes.
Geraldine, you were right.
Yes.
Please, can you explain a little on deductible and other stuff? I
Deductible
don't
means
really get. I don't really get that.
if you pay premiums on the life insurance, business life insurance, right?
Okay.
It means you're paying. They say the premiums paid by an employer in a business life insurance, which means you're paying premiums for an employee, and the company is going to be the owner of that policy. So if you are making payments on a policy, it means those are expenses to the company. And if they are expenses to the company, remember when we calculate taxes at the end of the year, we use the expenses to reduce the taxable income of the employer. For example, vehicle expenses, rent expense, meals for executives, all of those are expenses. So at the end of the year, when you have revenues, you have to calculate your total expenses and reduce your revenues by your expenses of the year to arrive at taxable income. And this is tax deductible by the employer, which means these expenses are going to be part of the expenses that you add up to reduce the revenues of the employer. And that process of reducing the revenues is called, is the process of being tax deductible to the employer.
Okay, sir.
For example, contributions by the employer to your 401k plan are tax deductible to the employer, meaning it helps to reduce the employer's expenses. Is that clear?
Yes, sir.
Yeah. It helps to increase employer expenses, thereby reducing their taxable income.
Correct.
To get some benefit from Uncle Sam.
Correct. Ms. Geraldine, you want to read this one?
Which of the following is an eligibility requirement for all Social Security disability income benefits?
A permanent kidney failure.
B?
Yes.
Yes.
Permanent
B is
kidney
the
failure.
answer.
Which of the following
Yes.
is an eligibility?
Which of these is an eligibility requirement for all? Remember, they say all.
D.
D.
Have attained fully insured status. Correct.
A.
Now, Ms. Geraldine, you were right in that having permanent kidney failure is one of the requirements, but one of the exceptions to have attained fully, or to have fully attained status. So even if you don't have fully attained status, if you have kidney failure, you'll still qualify for those benefits. So, yeah. Let's read the explanation. Although Social Security offers many benefits such as retirement, survivors, and Medicare, only those who have attained fully insured status are eligible for disability income benefits. Contributing to Social Security for 40 quarters or 10 years attains fully insured status. But if you have kidney failure, then that is an exception to having worked 40 years. Ms. Ebuko Nolowa, you want to read this one?
Yes. Which of the following statements regarding the taxation of modified endowment contract is false? Modified endowment contract. I'm not sure. I want to say withdrawals are not taxable.
I
That's
think
it should be C.
C.
Correct.
Mhm.
Modified endowment. Let me explain what a modified endowment contract is. A policy such as a universal life policy, right, has a maximum amount of money that you can put in a year. I don't have one of my illustrations active now.
Yes.
Let me see if I can. Okay, right here. This is an illustration that I did. Total face amount, base coverage, modal premium. There's what we call 7P. This is the maximum amount of money you can put in this policy in a year. They put this upper limit so that it does not become a modified endowment contract. A modified endowment contract would mean if you exceed the maximum amount that you can put in that policy, it is no longer seen by IRS rules as an insurance policy, but it is seen as an investment, or in other words, a modified endowment contract. That's why you see this policy here, they say MEC, modified endowment contract, no, which means it is not a modified endowment contract. So if you say for this policy, if you send Transamerica each year over $78,000 to put in this policy, they will not accept because they don't want it to become a modified endowment contract. Let's go back to that question. Which of the following statements regarding taxation of modified endowment contract is false? Now, when it becomes a modified endowment contract, then all of those benefits you have in an index universal life policy, for example, the ability to take loans, the ability to make withdrawals tax-free, you will lose them. So if you make withdrawals, they're going to be taxable. And that's correct. Any distributions from modified endowment contracts are taxable, including withdrawals and policy loans. So you'd never want to put more than your 7P into your index universal life policy in a year. All right, good stuff, good stuff. Ms. Vera, you want to read this one?
Which of the following would be considered a non-qualified retirement plan?
Non-qualified will be Roth.
What?
Odeva, can you briefly explain non-qualified?
No.
All right. So a split dollar plan. All right. So what is the difference between a qualified and a non-qualified retirement plan?
It's the
approved by IRS.
When you hear that word qualified, just think about approved by the IRS, and it is tax deferred. Tax deferred means the money you're putting in that plan, they will not tax you in the current year. They will tax you for that plan only when you withdraw the money. So taxation that's qualified. Taxation in a qualified plan, such as 401k plan, 403b, TSPs, taxation occurs only at withdrawal or distribution. Okay, so what is non-qualified? Non-qualified is any plan that you can decide to set up for your employees. The IRS does not need to approve of it. But in that plan, taxation is not deferred. The money that you put in that plan in that year will be seen as income and they will tax you in it. or tax you on it. Examples of non-qualified plans are individual annuities and deferred compensation plans for highly paid executives, split dollar insurance arrangements, and Section 162 executive bonus. So split dollar arrangements or split dollar insurance arrangements are one of those plans that are non-qualified, which means they do not have to be approved by the IRS. They can discriminate against other employees because see here, it's for executives. Does that make sense? Did I explain it?
Yeah, it makes some sense, but I thought that when we are moving these things, money into annuities, they will tell you IRA cannot be, Roth cannot be mixed with 401k because it's non-qualified. I didn't see this other one coming now.
That is true. You cannot mix Roth with 401k plan. Yeah. Ms. Ebuko Nolowa, can you read this one?
Yes. An employee is insured under her employer's group life plan. If she terminates her group coverage, which of the following statements is incorrect?
I'm going to give a dime to anybody who answers this one right.
I think it's D.
I think it's A.
I think it's B.
I think it's D is David. I don't know.
Mr. Oluwatosin, your dime is in the mail.
Okay, sir.
When,
D, right?
when you convert from a group policy plan, remember this, you'll see this in the exam, 100%. When you convert from a group policy plan to an individual policy plan, it can only be converted to a permanent plan.
Permanent, not time. Yeah.
It cannot be term.
Yes.
Okay.
Can only be converted to permanent, not a term.
Let's go back to the question again, please.
Okay.
And you have a reason to go to sleep, man.
All right. So let's look at the question.
Okay, incorrect.
Correct. All right. Mr. Oluwatosin, you want to read this one?
Okay, sir. A producer is helping a married couple determine the financial needs of their children in the event of one or both should die prematurely. This is a personal use of life insurance known as juvenile protection provision. No, survivor protection. I'm
This one is
confused.
either A or B.
This B.
No, it just A. If it's between A and B, then it should be A. Juvenile protection provision.
For their children in the event of life die prematurely. Okay, juvenile.
Survivor protection.
I was withdrawing to C, but
okay.
I was confused. But if it's not between A and B, then I'll go for A.
We've answered quite a few questions tonight. Quite a few questions.
Protection. One of them should die. Okay.
All right. Ms. Ebuko Nolowa, can you read this one?
Yes. Which of the following is not true of life settlement? Life settlement.
The seller must be terminally ill. Is it?
Yeah.
Okay, so what are they referring to here as life settlements? That's the first thing we want to ask. What they are referring to here as life settlements are what we call vertical arrangements. Vertical arrangements are when you have a policy, and let's say you're sick, terminally sick, mostly. You can take, say if that policy is worth $500,000, you can take that policy, go sell it for $450,000.
Okay.
And the people who engage in this kind of arrangements, or the people who transact, are called viators.
Okay. Okay. So I remember. Thank you.
So there could be
So it could be A.
So it could be A then.
A, it could not be greater than the cash value. You cannot sell it more than
you
what
can't
is
sell it
worth.
more than the current cash value.
You're mixing the cash value and the death benefit. That's why you're choosing A.
Oh, okay.
A policy can have the death benefit of $1 million and a cash value of maybe 300,000.
Okay.
So what is very important in vertical settlements is the death benefit.
They involve insurance policy with large face value.
What's the relevance of the key person insurance here? How is it related to this question?
It's not, and that's the answer.
Okay.
Just got yourself into it.
Let's take the old one out.
That's the odd one out. Okay.
Oh, see?
Oh, wow.
Oh, okay. We did not read C well. C says the seller must be terminally sick. Not necessarily.
Okay, not necessarily.
I got that.
So they actually could be used for key person insurance.
Yes.
Wow. Ms. Obukonolowa, read this explanation for us.
Okay. With life settlements, unlike with vertical settlements, the seller does not need to be terminally ill. They usually involve life insurance policies with a face amount of $250,000 or more, key person coverage, corporate-owned policies, or policies representing excess coverage that is no longer needed and could be sold for an amount greater than the current cash value.
True. So life settlements are a little bit different from vertical settlements in the fact that the seller does not need to be terminally sick. For vertical settlements, they need to be terminally sick. For life settlements, they do not necessarily need to be terminally sick. Okay. Ms. Lola, can you read this one?
Which of the following is not true regarding policy loan? B.
It's taxable from the cash value.
No,
sorry. The policy loan may be repaid after the policy is surrendered.
C. Is C. It's not taxable. I thought money borrowed from the cash value. No, it's not taxable.
The insurer can charge interest on outstanding loans.
Yeah.
Money borrowed from the cash value is taxable.
It is taxable.
It is
right?
taxable.
Yes.
But it says it's not true.
It's not.
What about
It's not
C?
true.
A loan may be repaid after the policy is surrendered.
Surrendered.
No, I think C, they are misstating it. They say policy loan may be repaid after the policy is surrendered, which means as you're surrendering the policy, let's say if there's a cash value in that policy, they will take whatever
money they owe.
Money you're owing.
Okay.
Such thing.
An insurer can charge interest on outstanding.
Money borrowed from cash value is taxable. It's not. But C might be a little bit misleading if you think that you surrender the policy, then you come after and pay the loan. If you think it that way, it might be wrong. But here they are saying you are surrendering the policy and they are taking their loan back from the cash.
At the point of surrender.
So money borrowed from cash value is not taxable.
No, it's not.
So what part of it is taxable?
Is it the interest or something?
No,
Yeah.
it's not. It's the interest is not taxable either.
Yeah,
Because
I
you
thought it
pay
was-
the...
So,
Go ahead.
No, I was thinking that the cash value will be taxable, and if you borrow from the interest, that's when it's not tax.
No.
I mean, the
You grow cash in the policy, okay? Like here, maybe it's gonna allow me show this, or it's gonna time out. Let me see. Let me go here.
So, Oga Valentine, you telling me that if I borrow, let's say I had 5 million and I had 1 million cash. If I borrow the 1 million cash, I'm not supposed to report that to the IRS?
It's your money. You're not supposed to. You should not report it.
Okay.
Yeah. Yeah. So let's take a look at this policy here, okay? Let's scroll down. See, like this guy, when he's 75 or 79, he's got $1.2 million here cash. You can come here and borrow $1 million, not taxable. And that is how you can take money out of these policies at retirement tax-free, because you just take it as a loan.
Okay.
You don't have to pay taxes on it. And then when you die, they will just take the amount of your outstanding loan out of your death benefit and pay the rest to your beneficiaries tax-free. Number 12. Ms. Vera, you want to read this one?
Okay. What percentage of a company's employees must be part of a non-contributory group life plan?
We said it was 75.
75%.
Non-contributory.
25.
We said it was 75 last time.
No, that's contributory.
75 is for contributory.
100%.
Oh, 100%.
100%. Okay.
Correct.
Where the company is paying for it.
Oh,
Oh,
no,
yeah.
contributory, 100%, yes.
Yeah.
Oh.
Right.
Non-contributory and the contributory. That's confusing now.
Mr. Des, can you read this one?
What is the penalty tax on premature contribution from a modified endowment contract, MEC?
Is it 10%?
Be 10%.
10%.
Let's see. That's correct.
Vale, I have a question. This modified endowment, does 401k consider as that too?
No.
Okay.
Yeah.
So the modified endowment is determined based on the 7-pay?
Absolutely.
Okay.
See, for this policy, your regular premium a year is $21,840, which is also called, look here, the target premium, $21,840. Monthly premium, $1,820. 7-pay is the highest amount you can put in there. You put over the 78,877, it becomes a modified endowment contract.
This is getting me so confused with 401k because when you talk, it almost sounds like, because with 401k, don't you have like a max? You can put above a certain amount?
Yes, but in 401k plan, they will not even allow you do it because if you make $300,000 a year, and the maximum that you can contribute in your 401k plan is a year is 23,500. Let's say in June, when you've already hit that 23,500, the company will not even take anything additional from your paycheck. Everything will come to you as income.
Wow.
And there's a 10% penalty if you take it out before the time, right?
Correct. If there's a distribution before you hit 59 and a half, you take, yes. Correct.
So what's the answer?
We already answered it.
10%.
10%.
Correct.
10%.
10%.
The penalty is 10%.
The answer.
All right. Ms. Geraldine, you want to read this one?
All of the following are business uses of life insurance except
Is it
A,
funding business continuation of the
Yes, general financial loss.
They can use life insurance they can issue executive bonuses in the form of life insurance.
How about B?
I think it's closer to D.
No, B is
D for
basically
David.
what we call buy-sell agreements.
D for David.
You're right.
Against companies'
D is the
general
answer.
financial loss.
Funding against the company's general financial loss. That's the except. Correct. And the last one, Ms. Ebuko.
Thank God we are here.
You want to close the night for us?
Okay. In a single employer group plan, what is the name of the policy issued to the employer?
Master contract.
Master contract.
Master contract.
Master contract.
Hmm.
86 or something.
Yes.
We wanted to have a marathon licensing class. This met that entire definition of a marathon licensing class.
Oh my goodness.
We didn't pass this one.
We didn't pass this one. We'll come back next time.
Well, we take the average of all the questions we took tonight.
Yes, we passed.
We passed.
Yeah, that shows we're all really tired.
Correct. But it was worth it. It was worth it.
Yes.
Yeah. So let's see which chapter we stop with.
Can we redo this chapter?
No.
Yes.
Tomorrow when we start, we'll redo this one.
Okay.
It's a bit complex, a little.
Yes. Yeah. But tonight we did great work. I really appreciate all of your contributions. I appreciate your presence and you know, and I appreciate you guys cooperating with this method that we're going and just not reading the questions because it's helping us zoom in on the answers and moving faster as well. You know, even Desmond appreciates it.
I appreciate, man. I appreciate that. We've really run a marathon today. Thank you so much, everyone, for hanging in there with all of us.
Correct. Yeah. All right. Good night, everyone. Tomorrow we resume 7 p.m.
7 p.m. That would be great.
Thank you so much.
All right.
Okay.
Again, if you're not registered for the exam, go and register. You should take this exam within the next 10 days.
Yes.
All right. If you need help registering, reach out to me. Let me help you.
Okay, sir.
All right.
All right, sir. Good night.
Good night.
Take care.
Good night, sir. Good night, everyone. Good night.
Good night, everyone.
Good
Good
night.
night.
Good night.
Good night.